Hi, this is Randy Finney with the Right Side of the Chart, and today is Tuesday, March 16th, 2021. In this video, we'll take a look at the equity markets and some of the other things I've been watching lately: crude oil, gold, energy stocks as well. We'll look at a couple of the ETFs, pretty much the last what I've been updating the last few days. All right, starting out here, this is QQQ. On the update this morning, here just to kind of recap, we had this big divergent high rising wedge breakdown. That put us in this trading range right here for a while. We'll zoom in real tight. And as posted this morning, we were testing that. That's resistance, the top of the trading range back here. And so far, that's where the Q's reversed. And I also, on that chart, I had a minor uptrend line. I'm just going to add it in here. In fact, yeah, I had hand drawn that one in after I took the screenshot. So let me just add that line there. So that's it. We're pretty much pinched between support and resistance. It's a minor uptrend line. It's not a lot of reactions, but enough that it could spark some selling, whereas a breakout above that would be bullish. So we're still, my convictions aren't very high. Still leaning towards the likelihood that this drop, this 12% or so correction in the Nasdaq 100 was the first first leg down in a correction with more downside to come. And if so, that would open the door. We need to still take out the recent lows. We hit that 297 target a week or so ago. We need to take that out to open the door for a move down here to 283. On the flip side, if you break above this level, that's going to be bullish. There is some minor resistance there. There's a gap support or gap resistance, but you're not far off all-time highs. Again, I always share with you what my thoughts are. I also try to convey, how strong my convictions are or not. But I do favor this scenario right now. I just can't put much better than maybe a 60-40 that the correction's over, that 12+% drop was it. 60% chance, again, just to try to give some rough numbers as of this point in time. These numbers are fluid. They're going to change over time, but as of now, that's where I'm at. So we can look at it this way. Certainly an objective short entry here at the top of the range, just like it was there at the bottom of that trading range, but that didn't pan out. But anything much above here, these numbers start going down pretty quickly too. Again, the bigger picture has the Nasdaq 100. If it does go on to make a new high anytime soon, that is, it will be a divergent high. We'll just take this line right here. We've had divergence building for quite a while. It's not as if it didn't play out. Again, it played out for the biggest drop in months, 12% or so correction. But should the market go to new highs, that divergence is only going to be bigger. It's going to look like this. Should we go to new highs in reverse, of course. You go on, blast on through another 20-30% higher, sooner or later those divergences will be negated or taken out. But as of now, they're still in place. And what I often say is breakouts to new highs that occur with negative divergence, especially if they have overbought conditions too, have a much higher rate of failing than those that don't have divergence. So to kind of summarize everything I just said, this would be what I would consider the last, if you had been scaling into shorts, if you had covered off 297 to reverse a bounce to play alongside bounce off that initial tag of that 297 target, this is where it'd be an objective to book profits or tighten stops up. Again, you can tighten stops, and or if you've been scaling in or wanting to get short on the bounce off 297, this would be the last place. After that, I wouldn't add to shorts. I'd wait, again, unless I see something in the charts, then I might. But as of now, like I said, that'd be pretty bullish if we take that out, at least near term, if it's anything other than a little whipsaw false breakout, and then fails. All right, next up, the S&P 500. Remember, this was almost all about the Nasdaq 100, that 12% drop. The SPY from high to low only dropped about not even 6%. I'm talking this high right here on February 16th, down to the low there on March 4th. There's a minor uptrend line which has been cracked, but just like QQQ, this marginal new high in SPY, or like QQQ would have if it goes up and puts a marginal new high, this marginal new high has done so with divergence in place as well. So I still it's just not my style to climb on and get all heavy into longs for the next leg up in the market. Again, I put a higher rate of it failing, and still believe at this point in time, based on the technicals, that despite anything's possible, but I think the risk reward is not favorable on the long side at this point. In fact, I think it's more favorable on the short side. What does that mean? I think the odds favor the next 10% move in the market, 10% plus, is more likely to be to the downside than to the upside. And there's some hedging stocks that were highlighted recently, potential hedge candidates, Microsoft, or pure play. I said either hedge up short positions or pure play long. Microsoft off the 228 support or just below. So far it's rallied, and this is, I'm doing this also for market analysis, whether you're in these stocks or you're just trying to get a gauge on where the market might be going. This is Microsoft. This is that big level right here. We've been in this trading range for a while, capped by, and let me give you the number on it. It's right about where we are, about 237 and change. But that's a big level. There it is. Yeah, we'll call it 238, this line right here. And that is the bottom of this gap. So we had this big gap down that was technically significant. There was minor support right there at about 240 and a quarter. Gap down, and since then we've been testing the bottom of that gap, and today we actually backfilled the gap. So if, and this is just an if Microsoft wants to take another leg down, at least it hasn't left any unfinished business. By that, I mean not all, but quite often gaps are backfilled, and that one has now been backfilled. So should Microsoft want to continue down, it's taken care of that, backfill the gap. So it's simple, guys. This is, just on Microsoft now, that's resistance, about 240 and a quarter, pretty much where today's high was, and support would be the top of that recent trading range. And I say the recent trading range, I'm talking a big multi-month traded range. It's boxed in here. I've covered this one quite a bit, but again, I know there's always new folks coming in or people catching up. That's the trading range Microsoft has been in for quite a while, and so it broke out, which is bullish. It back tested. So far it's held, and unless it fails, that's nothing but bullish. But again, the stock had big divergence here at the recent high. It was a divergent high, and that's it. Those are your levels to watch. Let's keep it simple. 228 or change, really the recent lows, and then this uptrend line right here. That to me would be very bearish if Microsoft comes back in there, because it would mean this entire breakout here was a false breakout, aka bull trap or whipsaw signal, if we fall back in the trading range. And I'm okay to give it a little room in the trading range, but I think it's this trend line here. If that's taken out, that should send Microsoft at minimum back down to the bottom of that trading range, which is 199. That would have a big impact on the market, and that's why I spend so much time covering these FANG stocks, because this is what the market is comprised of as far as the top weighted components. Amazon also good so far for the bounce off 29.43 as talked about. This is a list here. J&J good for the bounce. Again, they were all covered the day when they made this overshoot. I think it was on a Thursday. Yep, Thursday, March 4th. And so far good for nothing big, but 5% or so. Took out the downtrend line, so bullish if that holds. It's not at all impulsive. You ideally want to see a breakout impulsive. It's also not a major downtrend line. It's more of what I call a minor downtrend line. This was a more significant trend line, longer, and a lot more reactions on the trend line. Then you broke down, back tested, moved lower. Big support. It's covered, back then. That's why I made the case to step in and buy these guys on support. And the takeaway is, bigger picture, this would be bullish, because a breakout, back test of the key resistance level, and then off to the races. That's the bullish scenario for the Johnson & Johnson and the stock market. Whereas if all these breakouts like Microsoft, everything I just covered, fails, we fall back down well back below that 154.28 level, quite bearish, and most likely would take us at minimum down here to 137.15, possibly more, because that would be a very powerful whipsaw, or what we call bull trap, failed breakout to new highs. All right, and the other ones were, what else did I have for you? Walmart good for a bounce off that 128, remember, just below, so good for about a 6.5% bounce. But bigger picture was you had a big old bearish rising wedge pattern that broke down, back tested, setting up this little minor channel, broke that, back tested that, and then stair stepping lower. So, by all metrics, this is in a near-term downtrend right now. However, the case was made to buy it at support. So if you're long and you're gonna, you expect the market to have a strong rest of the year, 2021, or at least in the coming months, at this point it's prudent to either at least move stops up to your entry price or trail stops and let it run. Likewise, if you were just looking to game a bounce off support, you believe the market's going to take another leg down, then you can book profits here. I wouldn't short Walmart. Again, it was one of my favorite picks to be long, but I would not short that one. There's a lot better looking setups out there than that. Home Depot was a long off 247 support. One of the stronger ones so far. Nice bounce. Very bullish action on this one. 14% bounce off that support level, back above into the trading range, that recent trading range there. But it still has major resistance at the top of that range. So, not off to the races yet. It's been a nice bounceable trade. And again, this thing's going to go where the market goes because these are big, as I covered, these are big components of the S&P 500. And last but not least, Tesla, which was my least favorite of the group, and it actually broke support but then regained it. But so far, it took out this trend line, but the breakout was very muted, very, not very impulsive. Broke out, parked just above it, and it's been moving sideways in this tight little range here recently. And this one I think will lead the way down or outperform to the downside should that bearish scenario of another leg down in the market pan out. So that's the market for the most part. Oh, and then the small caps, of course. I like to trade the futures, but I'll cover. Oh, we actually broke down. When I started the video, we were still. Oh no, it's Crude that bounced off support. The IWM or RTY. I'm sorry, RTY are your small cap futures. That gave us our next sell signal this morning when I posted it. We were on this minor support level right there. Yesterday before I had this bearish rising wedge right here, breakdown, kick off minor support, and then finally we broke it. So that should open the door to a drop down to my first target there at 2258.80. Again, that's the actual support level. If you're targeting that, you cover a hair above it, and then if and when that goes and we get a deeper correction, this potential second target zone runs from about 2161 or so to about 2177 or so right there, target zone. And then also this chart was covered this morning. Here's IWM on a daily time frame. If you trade the ETF, you have this primary trend line right here, which it's still well above, and that is and has been a target of mine for a while. When you get too far away from the trend line, you come and visit it every now and then. And so we just recently put in a divergent high. That forms this megaphone type pattern here, but most importantly, you have this negative divergence that's been building. And again, you zoom in and you can see it even better up close. And the divergences are actually getting a little more steep, if you will. You can see the slope of these lines making much lower highs on this last thrust up to new highs. Prices made a higher high. With the indicators making a lower high. So that's negative divergence right there, and that would be the catalyst, the technical catalyst, if you will, for a move down to that 1039 level. And then again, getting a little more, that's more macro. To get a little micro is the 60-minute chart. So this is the one that helps you hone in your entries and exits. So if you were shorted here and you were waiting for the next sell signal after shorting the breakdown of the trend line, well, that's what you got today when we took out that minor support level right there. Crude oil, there's crude oil. The update this morning, we were right on this 63.79 support. So far, a little muted bounce off there. You can see we recently put in a small divergent high there. So that's it. You need to break that. That gives you your first check mark or next objective short into your add-on. And then the reaction low from I think it was last Tuesday right here, if I'm not mistaken, sometime last week. That'll open the door for a move down to the first target there, about $61, and quite likely my second target zone, which runs from about 58.90 up to about 59.45. Should that pan out and we get that drop in crude, which would be my preferred scenario. That should then translate to more downside in the energy stocks. The big one is XLE. This is what I call big oil. You know, has a heavy, very heavy weighting in ExxonMobil, Exxon, and Chevron, and big resistance level right here. I'm going to roll back again, just show you why it's a big level. This goes back for years. Right here, major reaction low, another one there, and we zoom in. That was right about when COVID was starting to hit, and it was a big technical support level, well defined. Once it broke right here, you gap down, and the energy stocks never looked back. They had a waterfall sell-off, and so that's a very technically significant level. As mentioned about a week or so ago, we hit that level, thereby providing objective short entry, with the next objective short entry to come on a break of this trend line, and this all meshes with what I'm seeing in crude oil. So yesterday we had the breakdown right there. There's your, you zoom in real tight, your breakdown candle, and follow through downside today. That opens the door for a move down at minimum that 47-ish target right there. And then the other ones, you get more bang for your buck if you trade XES. That's the oil and gas equipment and services ETF. You could draw a comparable trend line like this. Let me just tighten it up here. This will be comparable to that XLE, except we have a breakdown today. There's your sell signal. So there's a sell signal in SCS, minimum XCS, minimum target 55.44, and then 47.75, with a potential, if things get ugly and the market has another leg down, then I can easily see the energy stocks coming to backtest this major downtrend line that it broke out. So that would lead to a much bigger correction. But right now, again, those are my near-term targets: 55.44 and quite likely 47.75. And then finally XOP, and if you buy DRIP or Gush, those are the ones that track this sector, and that's it. You can see the primary uptrend line right there, broken here, back tested, setting it up in this channel, been in this price channel, and as of today, this line drifted a little, there it is. As of really yesterday is your breakdown candle, but it wasn't very impulsive, but today we're clearly below trend there, so that opens the door for more downside in XOP, which should translate into upside in DRIP. It's leveraged, but that would be your two-time leverage in the same sector that XOP tracks, which are the exploration and production stocks. Okay, and as highlighted this morning, gold has some minor resistance right here. It's pushing up against, needs to break that to open the door to my next target up there at 1757.40. I still like gold and GDX and the miners. After that, if and when this level goes about, let's say 1758, that should open the door for a move up to about at 1824-ish level right there. This was a bullish falling wedge pattern here on this 60-minute chart with divergence, so that was part of the case. And again, this was more of a hard buy, whereas gold here. Let me go to the GLD chart, show you what I'm talking about. Last time I mentioned it was more of a soft buy, a scale in. Back here, and at the top of the buy zone we got a nice rally out of it, hit it again, and then went to the bottom where that's solid support. This was moderate support. It's been on my chart for a while. Solid support, big level. So that's a to me a hard buy on gold with a stop somewhat below that the 158 level. Again, nothing big yet, but you're always going to get more bang for your buck if you trade, not always, but usually if you trade GDX. So gold's rallied about 4%, and the miners, at least via GDX, the gold mining ETF, has rallied about 10.5. So there it is. Took out that trend line recently. Positive divergence, nice looking chart, and still like that one. Bitcoin, for those interested, these are Bitcoin futures, symbol BRR. Here you had a downtrend line which was taken out. You had bullish divergence there. Simple stuff. You can see down below. Negative divergence, positive divergence, negative divergence, positive divergence, negative divergence. Now, that's why I'm bringing it up. That negative divergence led to this drop. That positive divergence led to this rally. This negative divergence there led to that correction. Positive divergence, etc., and so forth and so on. And that's it. So we've come full circle again. Negative divergence on Bitcoin futures. And so the proxies such as Riot and Overstock, should these divergences play out. Now you need to have a sell signal too, and that would be a break of 52, about 53,000 right there. It's 52,998 on my chart, so we'll call that 53,000. And then last but not least, Treasury bonds. I still think they still appear primed for a counter trend rally. They've been in a downtrend for a while, but building these divergences I started mentioning a couple weeks back, and still right there, basically just a slightly marginal new low, still positive divergence, even larger divergence now. And this is the end, by the way, guys. That's the 10-year Treasury bond futures. Still have that target up there at 133. 233 first target, second target at 134 173, final target 134 303, should this one pan out. And again, that would most likely coincide with a drop in another leg down the stock market, which is of course not a guarantee. It'll just help this trade if that happens. The other one is ZB, the long bond. This is and if you remember, part of the case for a rally in treasuries, this is TYX, the 30-year treasury bond yield. So yields are going to move inversely or opposite the way the prices move. So if you're bullish bonds, you buy TLT, which is the ETF that'll hold the 20 to 30-year bonds, or you buy ZB, the long bond futures I just showed you. And the case was that we rallied into a pretty significant resistance here, about 24.16. And that was a few weeks ago right there, and so far it's continued to check every advance. We've stopped cold. In other words, yields had been rising. This is what I call, or I'm going to call, the Powell folly or inflation trade. Powell's blinded and well, not blinded, he's just dismissive of the risks of inflation, and so the market's been pricing that in. Again, we can sit here and debate all day long, but I've showed you what commodity prices have done, not just agricultural commodities, but everything. Hard commodities, soft commodities, crude oil, copper, you name it, housing prices. So again, that's pricing in inflation on the long end of the curve. And but however, that's been a pretty good run, and we're at resistance, so that again makes a case for a pullback. And so if bonds break out, if the long bond rallies, you'll probably get a break of this minor trend line in TYX, so yields should fall, meaning bonds rally, and this is where you might want to look to cover long side trade on the long bond on TLT or ZB right there on a hit of that trend line. Okay, and that's it. We'll get the video out to you guys. That's most of what I'm watching, so we have an hour left of the day. Let's see what happens, and anything big happens before the close, or if I notice anything else that I missed, I'll get it out to you. Otherwise, we'll pick this up tomorrow. This has been Randy Finney with Right Side of the Chart. Have a great day.